Welcome to the Deep Dive. Today we're cracking open the latest Q3 earnings and guidance from Toll Brothers. The luxury home builder. We're going to unpack the numbers, see what they tell us about the high-end housing market. Ready? Okay, so first thing that really jumps out. Toll Brothers beat estimates this quarter. Pretty significantly. Yeah. Q3 FY2025, they beat on both revenue, the top line, and earnings per share, the bottom line. Specifically, EPS was $3.73 a share. Estimates were around $3.60, and revenue came in at $2.88 billion versus the $2.85 billion expected. So yeah, a solid beat.
Right, a beat on both. And what's interesting is how they got there. Their net income, the actual profit, was slightly down compared to last year, $369.6 million. But like you said, diluted EPS increased, $3.73 this year versus $3.60 last year's Q3. That really points to some operational efficiency, getting more earnings out of slightly less net income. Plus, home sales revenues, they were actually up 6%, and deliveries climbed 5% compared to Q3 last year. So good momentum there.
That efficiency angle is interesting. It's not just about selling more, it's about how they're selling. But what about other key things like margins, contracts? Are those looking healthy too?
Good question. Yeah, the details matter here. Their adjusted home sales gross margin was 27.5%. And adjusted is key, right? It pulls out interest, inventory write-downs, stuff like that. Gives a cleaner look at core profitability. And that 27.5%, it was actually above their own guidance. So operations are running really well. Even their SG&A selling general admin costs came in better than expected at 8.8% of revenue. Now, contracts, this is fascinating. The total value of net signed contracts was flat year over year, about $2.41 billion. But get this, the number of homes under contract actually fell by 4%.
Fewer homes, same total value.
Exactly, because the average sales price, the ASP for those new contracts, jumped 4.5% year over year. It hit a cool $1 million on average.
Wow, $1 million.
Yeah, so fewer units, but much pricier ones. Strong demand, but clearly concentrated at that very top end.
Right, which lines up with what the CEO, Doug Yearley Jr., said. He mentioned affordability pressures, but also the resilience of our luxury business and more affluent customer base. It sounds like their target buyer isn't feeling the pinch quite as much.
That seems to be the case. That $1 million average price tag tells a story. Even with rates where they are, that high-end buyer is still active. Maybe they see it differently. Less about the mortgage rate, more about the asset, the lifestyle. And Toll Brothers is leaning into it. They talk about strategically balancing price and pace and actively managing spec starts. Basically, being careful not to build too many homes without a buyer already lined up. It really shows how they're navigating this specific niche. It's quite different from the broader market.
Okay, so they're resilient. They have a clear strategy.
Yeah.
What are they expecting next? What's the forward guidance look like?
Well, their outlook seems pretty confident, actually. For Q4 FY 2025, they're guiding for higher deliveries, around 3,350 units. That's up quite a bit from the 2,959 they just delivered in Q3. And for the full fiscal year, FY 2025, they're aiming for about 11,200 deliveries overall. They also expect the average price of homes delivered in Q4 to be somewhere between $970,000 and $980,000. And they're guiding for an adjusted gross margin around 27.00% for Q4. Still very strong.
Oh, and worth noting, their financial position looks solid. Ended the quarter with over $850 million in cash. Plus, they're doing share buybacks, paying dividends. Looks like a really solid foundation.
Right. So bringing it all together, what is this strength at Toll Brothers, this focus on the luxury end? What does it ultimately tell you about the housing market right now, maybe even the wider economy? And maybe for you listening, something to think about. Given this clear split, Toll Brothers thriving at the high end while affordability is a huge issue elsewhere, how might this kind of two-track housing market evolve? What does this suggest about different kinds of consumers as we look ahead?